So let's do a couple more examples of accrual adjusting entries, both for expense and for revenue. So in this example, the company is Micro Computer Services, and they began operations on August 1st of 2015. And at the end of August, they're going to prepare monthly financial statements. And so they may have to make some adjustments for that purpose. So the first item we're told about is that on August 31st, the company owes its employees $800 in salaries and wages that will be paid on September 1st. So the financial statements are going to be prepared as of midnight on August 31st. So they have to be accurate as of that point in time, even though we know that the wages will be paid the next day. These are wages that were earned in August, so the labor services provided by these employees benefited the company in August. Therefore, they are an expense of August. So we need to record an adjusting entry that gets this expense into August on the income statement and recognizes on the balance sheet that the company has this obligation to its employees as of midnight on August 31st. So to do that, we're going to record an adjusting entry that is a debit to wage expense of $800 and a credit to wages payable, a liability account, for $800. And then we recognize that the next day they will pay this liability off by debiting wages payable and credit cash. Wages payable, reducing the liability, and using cash to do so. So the first is the adjusting entry to accrue the expense. The second is making payment. The next issue that we're faced with in the same problem is that on August 1st, the company borrowed $30,000 from a local bank on a 15-year mortgage, or a loan from the bank, and the annual interest rate is 10%. So in this case, now a month has gone by. They've had the benefit of using the bank's money, $30,000 for a month, and an annual interest rate of 10%. So we need to do a little calculation here. They have a $30,000 loan outstanding at an interest rate of 10%, which means that they will pay $3,000 per year in interest on this loan. But only 1 month has gone by, so they're only obligated to the bank for 1 month worth of interest. So if we divide this $3,000 by 3, we get by 12, we get 250.
Since we might use this, could you just say that? So if we divide that 3,000 by 12,
250, right?
It
25. Yeah, it should be right.
Yes.
So if we divide the 3,000 by 12, the number of months in a year, we get an interest expense of $250 per month. And that's the amount of expense they've incurred so far. So to record this entry, we record interest expense, a debit to interest expense of $250, and a credit to interest payable of $250. And by so doing, we have corrected the income statement, recording an expense for the period of $250, the cost of using the bank's money during that month, and we've recorded a liability on the balance sheet that is the amount of money we owe to the bank in addition to the principal that we've borrowed from the bank. The third example in this problem is that the company has revenue for services performed but unrecorded for August that totaled $1,100. So during the month they performed some services, but whatever those services were, there was not a transaction that triggered the accounting for the services or triggered the accounting for the revenue. So they have to remember to record an adjusting entry at the end of the period that records both the revenue they've earned and the account receivable due them from their customer. So to do that, in adjusting entry number 3, we're going to debit account receivable, an asset that is owed to them by the customer as a result of providing these services to the customer, and we're going to credit a revenue for the same amount, $1,100, because that's the revenue they earn during the month that they have not yet received. So this is an example of an adjusting entry that accrues a revenue.